Welcome to StokTok's deep dive into NXP Semiconductors. NXP designs and manufactures semiconductors used across automotive, industrial, Internet of Things, and mobile markets, essentially the chips that power connected devices and electric vehicles. As of May 5th, the stock is trading at $292.35. The stock sits near its 52-week high of $299.80, well above its 52-week low of $180.63. The 50-day moving average stands at $216.54, while the 200-day moving average is at $219.40. Meaning price is trading above both intermediate and longer-term trend lines. The RSI, or Relative Strength Index, is at 79.6, which indicates overbought conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. NXP Semiconductors is a Dutch-listed global semiconductor manufacturer with deep market penetration in automotive, where electric vehicle adoption and advanced driver assistance systems drive chip content growth. The company's moat rests on decades of automotive relationships, embedded software expertise, and design complexity that creates high switching costs for customers. The StokTok score is 44 out of 100, flagged as caution. Breaking this down, valuation rates 6 out of 20 stretched. Financial health is 15 out of 20 solid. Profitability is 16 out of 20 strong margins. Growth is 5 out of 20 compressed. Smart money engagement is 2 out of 20. Institutional interest is weak. Now, valuation. The question every investor has to answer: are you paying the right price? NXP trades at a price-to-earnings multiple of 28.3 times on trailing 12-month earnings, a significant premium to the broader semiconductor sector, which historically trades around 16 to 18 times earnings. The forward PE ratio based on next 12-month estimates is 20.37 times, which suggests some moderation in growth expectations. The price-to-earnings growth, or PEG ratio, which divides the PE by expected earnings growth, stands at 1.91, above the 1.0 threshold that typically indicates fair value. The enterprise value to EBITDA multiple is 17.9 times, well above sector averages of 12 to 14 times. The price-to-sales ratio is 6.03 times, indicating investors are paying $6 for every dollar of annual revenue. In our view, the economic moat is robust. Automotive customers face significant requalification costs and switching friction, but current valuation doesn't fully price in this durability. Our DCF model suggests the stock is trading at a discount to intrinsic value of approximately 42.83%, implying substantial upside if the company executes. In the most recent quarter, the second quarter of 2025, NXP delivered earnings per share of 2.72, beating consensus estimates of 2.66, a beat of approximately 2.3%. Revenue came in at $3.18 billion, which missed analyst expectations of $12.62 billion, representing a year-over-year contraction of 4.6%. Operating income was $0.88 billion, while net income totaled $1.12 billion. The after-hours stock reaction was mild, declining 0.2%, suggesting the market anticipated this revenue miss and took comfort in the earnings beat. Market sentiment around NXP Semiconductors leans bullish, driven by expectations for strong automotive chip demand and growing artificial intelligence-related opportunities. Wall Street analysts have a consensus mean price target of $296, with high estimates of $345 and low estimates of $200 from 31 covering analysts. Given the overbought technical setup, valuation is stretched in our view, though Wall Street consensus remains constructive. Moving to financial strength, how solid is the foundation? NXP scores a Piotroski F-score of 7.0 out of 9, which is solid. The Piotroski F-score is a 9-point health checklist that examines profitability trends, balance sheet quality, and cash flow generation. A score above 6 indicates a financially healthy business. The Altman Z score, which models bankruptcy risk using profitability, leverage, liquidity, and solvency metrics, is 3.94, well above the 3.0 safe zone threshold. NXP's cash-to-debt ratio is 0.29, meaning the company has only 29 cents in cash for every dollar of debt. This is below ideal, though not alarming for a capital-intensive semiconductor manufacturer. Interest coverage stands at 6.78 times. The company generates $6.78 in operating income for every dollar of interest expense, a comfortable cushion. The current ratio, a measure of short-term liquidity, is 2.24, meaning NXP has $2.24 in current assets for every dollar of current liabilities, well above the minimum threshold of 1.0. Debt to equity is 1.07, indicating the company carries slightly more debt than shareholder equity. For a semiconductor capital spender, this leverage is reasonable but bears monitoring. Overall, the balance sheet is resilient. The company has sufficient liquidity, manageable leverage, and stable coverage metrics. Financial strength is a core competitive advantage here. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, sits at 12.06%, a respectable figure that exceeds the company's weighted average cost of capital, suggesting management deploys shareholder capital productively. The gross margin, the percentage of revenue remaining after cost of goods sold, is 55.05%. This exceptional gross margin reflects the high value added in semiconductor design and the pricing power afforded by customer switching costs in automotive applications. Operating margin, the percentage of revenue that flows through to operating income, is 25.48%, among the highest in the semiconductor industry. Net margin, which shows how much revenue becomes actual profit after all expenses including taxes, is 21.03%, indicating that for every dollar of sales, NXP retains approximately 21 cents as profit. Free cash flow margin, the percentage of revenue converted to actual cash available to shareholders, is 20.25%. These margins are pristine and demonstrate capital efficiency. Return on equity, which measures how effectively management deploys shareholder capital, is 26.57%, exceptional. Return on assets is 10.17%. In the second quarter of 2025, these margin profiles held firm, with the company converting nearly every dollar of gross profit into operating income. The profitability machine is firing on all cylinders. On to growth. Is this business expanding, and at what rate? Here is where caution enters the thesis. Revenue growth over the trailing 3 years stands at negative 2.4%, meaning NXP has shrunk slightly on a top-line basis. Over the past 5 years, however, revenue growth reaches 8.7%, indicating that cyclical headwinds from the semiconductor downturn and macro weakness have temporarily suppressed recent results. In the second quarter of 2025 specifically, revenue declined 4.6% year-over-year, a material contraction that reflects weakness in certain end markets and inventory corrections among customers. Book value growth over the past 3 years is 11.5%, a healthy trajectory that shows retained earnings are building shareholder equity at a solid pace. The dividend yield is 1.36%, modest but stable. Management has signaled confidence in cash generation by maintaining the dividend through cycles. The growth question is critical. The data suggests NXP is entering a recovery phase after a cyclical downturn, but this is not a high-growth semiconductor name. Investors are betting on a turnaround in automotive demand and artificial intelligence acceleration, but near-term revenue momentum remains negative. Consensus earnings per share estimates for the second quarter of 2026 stand at 3.53, with analyst ranges from 3.50 to 3.70, reflecting expectations for roughly 25% year-over-year earnings growth as the cycle recovers. Now let's talk smart money. What institutional capital is actually doing with this name? The verdict is unambiguous. Smart money engagement is weak. 9 top-tier investment gurus currently hold NXP, but recent activity is mixed. First Pacific Advisors, holding 2.23% of their portfolio in the name, increased their stake by 0.17%, a modest add. Conversely, Christopher Bloomstrand at Semper Augustus, which holds 0.33% of his portfolio in NXP, reduced his position by 0.72%. Only 5.7% of 13F institutional filers, those who must report holdings quarterly to the SEC, were net buyers of the stock in the most recent filing period. In institutional investing, a reading above 50% signals net bullish positioning. 5.7% is deeply net bearish. Insider ownership is exceptionally low at 0.52%, meaning the management team owns barely 0.5% of the company. This creates a principal-agent problem. Management has little skin in the game. Over the past 3 months, there were 0 insider buys and 3 insider sells, indicating confidence in the stock's price and a desire for diversification among company executives. The weak smart money engagement and minimal insider ownership are red flags. Typically, when serious money managers and company insiders are accumulating stock, it signals conviction. The absence here suggests skepticism about near-term catalysts and risk-reward. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a meaningful premium to the semiconductor sector on most metrics, though our DCF analysis suggests a 42% discount to intrinsic value, presenting potential upside if execution continues. But entry here is aggressive given elevated technicals. On financial strength, the balance sheet is fortress-like, with solid coverage metrics, adequate liquidity, and manageable leverage. This is not a credit risk. On profitability, NXP is a cash generation machine with margins among the best in the industry and exemplary returns on capital. The business fundamentals are pristine. On growth, this is the weak link. Revenue has contracted over 3 years despite a solid 5-year track record, and the company is cycling through a downturn. Though artificial intelligence and automotive electrification present medium-term catalysts. On smart money, institutional investors are net sellers, insider ownership is trivial, and recent executive transactions have been net sales. Conviction among serious money managers is absent. The second quarter 2025 earnings beat on the bottom line while missing on revenue, and the market response was muted, suggesting limited enthusiasm for the current valuation. In our view, NXP Semiconductors presents a paradox. Excellent profitability and financial health paired with negative near-term revenue growth, high valuation multiples, and weak institutional interest. The setup looks interesting for patient capital willing to wait for a cyclical recovery and willing to accept overbought technicals. For investors uncomfortable with the current valuation or skeptical of near-term catalysts, the risk-reward does not justify entry. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on NXP Semiconductors. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.